Hey everybody, Courtney Smith here with our March 6th edition of Wall Street Winners. Well, big change in my attitude. I'm more bearish. Now, there's really two major reasons why I'm becoming more bearish. The first one is that inflation remains high. And so I think that, and as I've been telling my private clients, we're going to see the Fed raise interest rates higher and longer than the market thinks. Right now, the market thinks that we're going to hit a high of 5.25% in August, but no, I don't think that's the case. Once again, as I tell my Stock Navigator clients, we're going to be getting over 6%, and we aren't going to be peaking until 2024. Why? Because inflation remains high. We're seeing a stability in the volatile parts of inflation, and we're still seeing increasing levels of inflation in the sticky elements. What are the sticky elements? Wages and rents are the two primary ones, and both of those are actually increasing in inflation. So inflation's not going to be coming down anymore. We've seen the bottom in inflation, and the Fed's going to have to raise interest rates more than the market thinks. So if the market, if interest rates go up more than the market thinks, that's going to be bearish for the stock market. Now, the timing of that we'll talk about in a minute. The other factor, we have shrinking money supply. I got you bullish in 2020, the largest bull market in history. In spite of terrible economic news, it didn't matter because the Fed was flooding the market with trillions of dollars of new money supply. Now, money supply is shrinking, and that is a major bearish feature. Let's take a look at the money supply. Here you can see that starting in 2020, the Fed added $3 trillion to monetary base. In other words, they doubled the monetary base. This is 100% gain in monetary base. And monetary base is the raw material that all money supply is made from. But look at what's happening now. They've cut the monetary base now by about $1 trillion. That's $1 trillion that's going to come out of the stock market. It's going to come out of crypto. It's going to come out of real estate. All the things that were bubblicious caused by this $3 trillion, all the bubbles have burst, but we're still in bear markets in everything but the stock market. So bear markets in real estate. I'm going to say long-term we're in a bear market in crypto, although we have seen some strength recently. We'll talk about that later in this presentation as well. So how do we play this major change to bearishness? Well, to me, it's a battle between what I just showed you, higher, longer interest rates, declining liquidity, but the market, of course, doesn't look at the current situation. It looks at the future, and the future, of course, is better than the present. In other words, they will ease monetary policy down the road. I think, though, it might not be until 2024. But here's the thing. Here's how I strategize how to play the market. As you can see, we're in a big channel formation here on the S&P, a bullish channel formation. Although look down at the bottom of the chart, you can see that the purple predictor is showing us that's called on-balance volume. That shows us that the smart money is selling these rallies. So I don't try to predict the market so much as I follow the market. So if you can see on Thursday and Friday, we had very strong price action on expectation that the Fed is going to ease monetary policy. Okay, great. If that's the case, we're long stocks right now in our fully paid up members section. And we'll remain long stocks. But if we start to break down, particularly if we break the lows that we made here in January or at the end of 2022, if we break these lows here, I'm going to move aggressively to the short side of the market. Now, which is it going to be? Are we going to go into are we going to resume the big bear market of 2022? Or are we going to continue to move higher? I just made the case for a bear market, but I'll wait until the market tells me that it's a bear market. Until then, I will remain tepidly long, but I will have my finger on the trigger to go short very quickly. Dow Jones, can see in the upper right-hand corner, we can see that the buying pressure exploded up. That's excellent for the market. NASDAQ exploded up, but also purple predictor not as strong as it used to be. Seasonality, we're still on our seasonal bull signal. And if you look right here, you can see the purple predictor for IWM, which is what this is a chart of, is taking off. These are small cap stocks. That's bullish as well. This shouldn't say neutral. It should say bullish over here on the right-hand side. Okay, and you can see that from a seasonal perspective, we should be all clear. So maybe my bearishness is going to kick in here in this May negative seasonality, okay? So the market will discount, the Fed's going to ease, the Fed's going to ease, the Fed's going to ease. Oh, wait a minute, maybe they aren't. Hammerama the market. This is how we combine seasonality with our fundamental perspective. Asset allocation, getting a little bit of money out of the bond market and into stocks, that's good. And we also started to see an increase in risk on for the stock market. If they like risk, they like stocks. If they don't like risk, they like bonds. Global shares also popped up. I think they're going to be a leader. I don't have them in my portfolio anymore, but I think we're going to have to head back over and buy more global shares. Yield curve slowly moving in a bullish direction, but this is one of the factors of why I think we're going to see the Fed, why we're going to see the economy move sharply lower later this year. Bonds should continue lower, actually, a little bit of a rally over the next week or two, and then we're going to resume the bear market. But here you can see bullish. This is, I shouldn't say bullish. This is higher interest rates, so it's bearish for bonds. Down here, you can see gold started to move up. You can see here that the CRB has stabilized. So we're starting to see more elements that will cause higher long-term interest rates. If that's the case, the dollar will continue to move higher. Now, the dollar will continue to move higher over the near term. You can see the RSI got up to almost to 70, and we've stabilized here a little bit, okay? But I'm looking for the dollar to continue to move higher near term, but much lower longer term. But look, the dollar went up and gold went up at the same time. Why? Because real interest rates went down. But nonetheless, I can't get excited about the gold market yet. Our gold key indicators, though, we got at least up to 1 neutral and 2 bearish. So that is a step in the right direction. Right here, the CRB, you can see, which is commodity prices, which feeds into inflation, by the way, broke to a new high here. We're in a very sluggish bull market here, and that does help the gold market out. Crude oil explodes to the upside. Purple predictors telling us it's going to be bullish. I talked about crude oil a lot a few weeks ago. I'm getting more and more bullish because of increase in demand from China is the short reason why I'm more bullish, and declining supply. So when I can get 1 to 4 million barrels a day of increased demand from China, and supply is, let's say, stable or down a little bit, that's a very bullish scenario. The question is, the bearish scenario is, well, when the recession hits, that will clip off a lot of demand. So how do I play it? Short-term bullish, long-term bearish. Bitcoin starting to collapse down. Smart money is totally selling this rally. Look at what the purple predictor is doing. It's collapsing. So what we had was, we went up here, we made a new high on Bitcoin. That looked very bullish. It sucked in all the suckers. Retail investors. And then you can see we failed to make a new high. Purple predictor makes a high, price makes a high. Price makes a new high, purple predictor doesn't. We've got an unbalanced volume divergence. That's very, very bearish. If we break these lows here, that would signal we're heading back to the old lows down here in the $16,000 range. And of course, I keep thinking we're going to hit 13,000 or lower. All right, everybody, we will talk to you later. Hey, freebies, you know we love having you here every week watching the free edition of Wall Street Winners. But let me give you a little bit of a pitch of why you should actually upgrade and get the fully paid up member version. The big difference between them are two big differences between the freebie and the fully paid up version. Number one, the fully paid up version has more extensive analysis, which means that the prognostications are more accurate and you get greater insights into what is actually happening in the market and why it's going to happen. But we're also talking about the dollar. We're talking about the bond market, the crypto market. But of course, we focus on the stock market. So better, greater, more analysis so you understand what's really going on and how reality is creating profits and how we're going to create profits in the market. Number two, and this is most important, there's actual trade recommendations. So in the freebie section, I say, well, I'm bullish on the dollar, or I think we're going to have a dip in the market and then an explosion to the upside, whatever I'm saying. You want to be able to see what I'm actually doing in the real world. So I put out specific recommendations. Now, these recommendations are actionable. They tell you exactly what the stock is. They tell you exactly the price to enter, and I tell you exactly the price to exit. So there's no doubt you can take action and you can make money. We're pushing 3 decades of publishing Wall Street Winners, and every year has been a winning year. I don't care if it's a bull market. I don't care if it's a bear market. My job, because I am a professional investor, and I do the same trades that I recommend to you, by the way. I'm putting the same orders in. So you and we're going to see the same profits. But here's the point. As a pro trader, my job is to make money trading every day. Every day. I wish I could make it every day. Every year, okay? Every month. Because I need to know I want to buy steak, I don't want to eat oatmeal. You got it? All right. The difference between Wall Street Winners and all the other newsletters out there are, number one, I'm a professional trader. They often are amateurs. Number two, I ran the top performing global macro hedge fund in the world. How many of them have ever run a hedge fund, let alone a top performing one? Hulbert rated this newsletter, Wall Street Winners, as the best performing newsletter ever. Number three, I also manage the number one growth mutual fund in the United States. Quick! How many newsletter writers have ever managed a mutual fund, let alone a high performing one? So, what you're getting is my 50 years of experience at picking stocks and making money. That's why you should subscribe. This is a newsletter that doesn't cost you anything. Yes, you have to pay money every month, but the profits from the trades should more than cover the cost of the subscription. So this is a free newsletter if you take action using the trades that I put in here. Anyway, I hope to see you upgrade and become not just a freebie member. You know we love you, but we'd love to even have you come as a fully paid up member and get even more value than you're getting now. All you have to do is go to WSW2021.com. That's WSW2021.com. Sign up. Let's get going. I want to share greater analysis and great trades with you. We'll talk to you later. Thanks very much, freebies. You know we love you.